Hi, I'm Tom Dalton. This is part one of a four-part video series on partnership distributions. In this video, I'll describe the rules for proportionate current distributions of cash and property. Let's dive right in. A current distribution means that a partner receiving the distribution remains as a partner in an ongoing partnership or LLC. A proportionate distribution means that the distribution does not change any partner's ultimate share of ordinary income in the assets. It is the simplest but most common form of distribution. This video is focused on this box, current proportionate distributions. Let's start with cash distributions. In this example, we have a limited partnership with two partners, Laura General and Robert Limited. As a general partner, Laura is allocated 100% of the recourse liabilities, and Robert is allocated none. Their tax basis capital accounts equal their net invested capital in the partnership. So, Laura's tax basis in the partnership interest is $130,000, which is the $50,000 tax basis capital account plus all $80,000 of the liabilities. Robert's tax basis in the partnership is only his tax basis capital account of $50,000. The cash and the land are not ordinary income assets, so Laura and Robert can change their interests in cash and land without creating a disproportionate distribution. The accounts receivable has a zero tax basis, meaning the partnership has not yet recognized any revenue from these receivables. They are what is defined as unrealized receivables and will generate ordinary income when collected. If Laura or Robert somehow alter their 50% interest in the accounts receivable, it would be a disproportionate distribution. In all of the examples in this video, let's assume that the distributions are proportionate and each partner's proportionate interest in the accounts receivable remain at 50%. IRC Section 731 states that partnership distributions are non-taxable unless distributions of cash or marketable securities exceed the partner's tax basis in the partnership interest. Section 733 requires a partner to recognize capital gain to the extent his or her tax basis in the partnership goes negative. Recognizing the gain, of course, will bring the negative tax basis back up to zero. Assume that both partners take a $40,000 cash distribution. Laura's tax basis drops to $90,000, which is the $10,000 tax capital account plus the $80,000 of recourse liabilities. Robert's tax basis drops to $10,000, his capital account. As a limited partner, he does not have a share of the recourse liabilities. No gain is recognized because each partner's tax basis in the partnership remains positive. Instead, assume both partners take a $60,000 cash distribution. Laura's tax basis drops to $70,000, still positive, so she has no gain. Robert, on the other hand, now has a negative $10,000 tax basis, which is not allowed under Section 733. So Robert recognizes capital gain of $10,000, which brings his outside tax basis back up to zero. Notice that his inside tax basis is still a negative $10,000. What happens if a partner takes a current distribution of non-cash property? Well, if the property is not cash or marketable securities, then there is no gain to the partner. Section 733 states that a partner's tax basis in the partnership interest drops by the amount of the distributed basis of the property, but never below zero. And if the basis can't drop below zero, then a proportionate property distribution cannot create taxable gain. Let's go back to where both partners take a $40,000 cash distribution, and the balance sheet should look like this. There was no gain to either partner on the cash distribution. Now let's include a distribution of 50% of the land to each partner and see what happens. Laura's tax basis in the partnership is a positive $90,000 after considering the cash distribution. She still has a $10,000 tax capital account and the entire $80,000 of recourse liabilities. When the land is distributed, Section 732 says that $25,000 of her partnership tax basis transfers to the land, and she now has a $25,000 tax basis in her 50% share of the distributed land. After the land distribution, Laura's tax basis in the partnership is $65,000, which is a negative $15,000 tax capital account plus the $80,000 recourse liability. Robert, on the other hand, only has $10,000 of tax basis in his partnership interest. His $10,000 of partnership basis transfers to the land, but $10,000 isn't enough to achieve carryover basis in the land. He reduces his tax basis in the partnership to zero, and now he has a $10,000 tax basis in the land, instead of $25,000 like Laura. There is no gain to either partner, but Robert ends up with a lower tax basis in the land and a zero tax basis in the partnership interest. Although Robert's outside tax basis in the partnership stops at zero, his inside tax basis is a negative $15,000, as shown by his tax basis capital account. That's okay. It's the outside tax basis that cannot go negative. If all or part of the accounts receivable were proportionately distributed to Laura and Robert, the accounts receivable would keep the zero tax basis that it had within the partnership. In a current distribution, Section 732 states that distributed assets can take no more than a carryover tax basis. They do not receive a step-up in tax basis. Also, no loss can be recognized by a partner on a current distribution, regardless of whether the distribution is in cash or property. How do we allocate tax basis to distributed property if multiple assets are distributed? We'll tackle that problem in the Part 4 video. In the next video, Part 2, we'll look at what happens with distributions when a partnership interest terminates. It's a lot like what we've seen here with a couple of important differences.